If you give your bank $1,000 and you put that money into your savings account or into your checking account, here's the question. How much of that $1,000 can the bank turn around and lend out? Is it $500? Is it $700? Guys, would it surprise you if I said that it's actually $10,000? How in the world does that work?
We're Rod and Melody, your guides to living in Salt Lake City and beyond. With over 30 years in Utah real estate, we're here to help you navigate this beautiful state with confidence. We make videos about living in Salt Lake, exploring the suburbs, and what life in Utah is really like. We've helped over 1,400 families make their move in, out, and around Utah. And whether you're headed to St. George, South Jordan, or Smithfield, we've got you covered.
Well, I was recently at a town hall meeting in Draper, Utah with lawmakers and constituents, and there was something that kept getting tossed up. We were talking about the affordability crisis, specifically in housing in our state, and how that's being impacted. And there has been a lot of stuff going around on Instagram and on TikTok. What it said is that, and what they said in the meeting is that 4 out of every $5 that are in circulation today in the United States was printed since 2020. Now, I know that's a stat that's been going around, and I don't think that everybody that was talking about it and throwing that out there really understood how it worked, because there was a lot of negativity towards the past administration and their loose policies. And while some of that is legitimate, I think we need to understand really how commercial banks work in order to debunk the myth and really understand how this all works to help support our economy. Yes, if you put $1,000 into the bank, in most cases, they can lend out $10,000, in essence, creating money out of thin air, which is where that figure comes from. We're going to go back a few years, and we're going to talk about a reserve requirement that banks had back, in the 80s, in the 90s. It was required that they had a certain amount of money held in reserves in the bank. So that reserve requirement was usually around 10%. And you could lower that reserve requirement to create more money, or raise that reserve requirement to slow down the amount of money that went in. Would it surprise you if I said since 2020, the reserve requirement is 0%? That's right, the reserve requirement for banks is 0%. Does that mean they can lend out whatever amount of money without having to have any money in the bank to be able to lend it out and just create as much money as they want out of thin air? It is a little bit different today than that. So what they've determined is that not all loans are created equal. For example, a mortgage which is backed by a house and where somebody's going to live, it's one of the basic needs, has a lot lower risk than, say, a credit card where there's nothing securing the debt except somebody's credit score and their ability to pay that money back that they borrow. So different types of loans are different risks. So what they've come out and done today is they use what's called a risk-weighted assessment. Let's take an example. Let's say that a bank wants to lend out $500,000 to a buyer to purchase a new home. How much money do they have to have in reserves in order to lend $500,000? Well, the approximate risk-weighted asset for a mortgage is about 50%. So on a $500,000 loan, you multiply it by 50% to get the RWA, which is $250,000. Banks are typically required to have 10% capital against their assets, which are loans, right? So 10% capital. So in this case, if the RWA is 50%, because it's a fairly low risk, $250,000, and the bank has to have 10% of that to be able to do the $500,000 loan. So in essence, if the bank has $25,000 in reserves, they can create out of thin air $475,000 that gets pushed into the economy. Now, there's one other figure in there. I'm just going to talk about it really quick so that everybody understands. There is an expected loss on a loan. There's an expected loss percentage on a loan. So for a house, it's a fairly low expected loss. It's actually 0.6% right now, or roughly 0.6%. For a credit card, it might be a lot higher. But in this case, 0.6% of the loan amount, which is $500,000, is $3,000. So they're required to not only have the 10% of their RWA, but they're also supposed to have an additional amount of capital on hand for that expected loss. So in this case, it's $28,000 total. So they create $472,000 out of thin air. Now, if you guys can remember, from 2020 to 2023, mortgage rates were extremely low and everybody was doing everything they could to buy as many houses as they possibly could during that time. I know for us, for example, on one home that we had on the market, we had over 95 offers on one home. And that's the reason why, is because mortgage rates were so low. And so a lot of money was being created by banks lending mortgages, and it pushed a lot of money into circulation, which led to a little bit of an inflation problem. Today, the mortgage rates are a lot higher, and what that has done is it's really slowed down borrowing, which is probably healthy for controlling inflation and things like that. It sure made an affordability crisis in housing, as most people can't afford to purchase a home today because of the interest rates and because of what their payment requirements are. And so it's trying to find that balance all the time. So when people are out there, bashing the prior administration, and look, for a lot of reasons, I get it, I totally understand, I don't care who you love or who you don't love, but it's not completely accurate to blame the 4 out of $5 in circulation today on the administration, maybe more on the Federal Reserve and some of the policies that they had. The only reason that interest rates remained so low for so long is because the Federal Reserve was buying mortgage-backed securities to make sure that the economy kept going during a very difficult time, during a very expected difficult time with the COVID crisis. And so they made borrowing money and creating money really easy, which pumped a lot of money into circulation. We're now paying for that. Our kids are paying for that. We totally understand it. But hopefully this has been good for you to listen to and to be able to understand how money is created. It's not really printed, but how it's created and how it gets into circulation. It's primarily through debt and through the loans that banks do. But when a bank can have $28,000 on hand and create $472,000 into the economy, it creates a lot of money in the economy, and people are like, man, where did all this wealth come from? That's where it came from. So hopefully, good information. Guys, I'd love to hear your feedback. If this has been new information to you, as I listen to, podcasts, there's a podcast that I listen to, and they've been talking about this 4 out of $5 printed, and no wonder we've got so many problems and all this kind of stuff. It's a little bit more complicated. So hopefully this has been good for you. Look forward to hearing back from you. And if this has been good, please like and follow so that you get notified when we put out content like this, if this is something that you guys are interested in hearing in the future. Talk to you soon.